Hi, you want to learn about the income statement? Well, let me explain to you. Here's how a 22-year professor explains the income statement to his people. Well, the income statement is a very simple device, guys, and I'm going to explain it to you in 2 minutes so you will be able to read any income statement of any company in the world, around the globe, India, China, New Zealand, Australia, America, Canada, any country. It's from scratch. So let's begin from the top. The top part is something called revenue or sales. Completely depends on country. It remains the same. It is the most important figure. It is the amount of money you make. Whether you're selling software, whether you're selling trucks, whether you're like a company like Caterpillar, ticker CAT, or whether you're a company like Oracle, software database company, ticker ORCL, whatever you're doing, this is the most important number. How much money are you making in that quarter or in that year? All right. So whether it's a quarterly report, it's a yearly report, it's the same format. It's stupid easy. I'm going to make that super simple for you. So this is sales or revenue, whatever. Then the next line item is called COGS, which is cost of goods sold. In some places, it is called cost of making goods. Whatever it is, it's the same thing. Or the cost of selling. Well, what is this? This is basically whatever you are selling, how much did it cost you? Right? So if you're selling something for $10 and it costs you like $5, so the $5 is just COGS, cost of goods sold. When it says goods, it could mean anything. It could mean software, it could mean hardware, it could mean trucks, it could mean televisions, it could mean lights, phones, anything. This is your COGS. Now, here you have to keep some focus on that. Anything that is related to COGS, that means the labor used to make the COGS, for example, the labor that carried the COGS from the manufacturing unit to your business place, that is actually part of COGS. It is actually a trading expense. And we can talk about that later because it's a little bit of advanced, but we'll talk about it later in some other video. So this is it. You've got the income statement. What you get from here is revenue minus COGS, which is gross profit, GP, which we call that. Well, gross profit basically means it's kind of profit, but well, not kind of profit. There are some things that we need to focus on. Next on the line, we have other stuffs like operating expenses. Now, what are operating expenses? Well, you will see, as the name suggests, it basically means the expenses you need to take, you need to burn through to operate your business. Someone was trying to say it's called pussiness. No, business, biz, whatever. So this is basically R&D, which is research and development, which is for a company called Oracle would be there, obviously. Then you have S&M, which is sales and marketing, and then you have G&A, which is general and administration. My teacher used to say, guys, if you don't understand something you don't want to put somewhere, throw that stupid thing inside the G&A bin. So your office stationery and the light and the plumbing, whatever the stupid things you do in your office or whatever company you're working in, that thing is all going to go into G&A, which is general and, other expenses. General administration expenses. So that has happened. So we have gross profit minus operating expenses, the operational expenses, which is R&D, research and development, sales and marketing, S&M, and G&A. We deduct that and we get something. This is very important. We have operating profit, right? We still don't have a lot of things. We have still a lot of things to do. So wait, calm down. Now we have to do something really important. Now we need to deduct depreciation. See, depreciation is an imaginary expense people do all the time to save taxes. Let me give you an example. You have $10, you pay a 30% flat tax in your country. So 30% of $10 is $3. Oh my God, a lot of money. You're going to do something with that, What we do is we depreciate by $1. So you take $10 and you depreciate by $1. That is how you say in Canada. I'm not Canadian, my teacher is. You depreciate by $1, that's $9. So 30% of $9 is how much? 2.7. Earlier you were paying $3, now you're paying 2.7 bucks. So that 0.3 buck of the third of $1 is the money you save. How? By doing a simple trick called depreciation. Simple as that. In the following video, where I make a video on cash flow statement, if that video even marks and does well, which means crosses 100 views, I will explain how that works and how we add back depreciation into our cash to know the real cash flow. Back to the income statement. So in income statement, we take the depreciation and we get a number, we get a figure, whatever it may be, and then we deduct the taxes. Once the taxes are done, well, Now it's pretty easy. We get something which is called net profit. That is the important figure. That is what you say. What is the bottom line? This is the bottom line, my friend. This is what people are looking after, running after. The top line that you see, revenue or sales, whatever you may call that, and the bottom line. These are the two most important figures which people look at, investment bankers look at all the time. This is how the stock rises. Because if the bottom line keeps rising 10%, 10%, 20%, 20%, 20%, the stock's going to keep rising, 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 rising. That is how it works. And this is how a simple income statement works, guys. This is how easy it is. Save this video. So if you ever analyze an income statement and you don't understand that, watch it again as a good tutorial or lecture. And I'm really grateful for you watched. I'll talk to you soon. Thank you.